Well, we gotta address the Bears again, out of respect for the Bears. Yes, we have to respect the Bears. We've got to address how the Bears could be right and where the Bears could be right. Except in this video, beyond just talking about their ideas, I'm going to go through specifically some stocks that I'm bearish on and why, and some sector, a specific sector that I'm bullish on and why that sector I think is actually still oversold to a good degree. So first, we've touched on this piece before, but we touched on the first half. This is the second half. And it's really a Mike Wilson, Morgan Stanley piece where we talk about the risk of a credit crunch materially expanding. It is, looks like I've got a little bit, there we go. Okay, sorry. Looked like there was a little bit of an oopsie doopsie there for a moment. So anyway, when it comes to a credit crunch, what do we have to pay attention to? Well, all of the things on this list, actually. See, a lot of us think, oh, it's just going to be mortgages that maybe have a tighter lending standard, or maybe car loans will be a little harder to get. But this is actually important. When we look at banks, look at all of the different types of lending that you can get. And in a credit crunch environment, all of these get restricted. I'll actually start from the bottom up. Blocks. Do you know what a block is? Well, if you don't, you should. It is a business line of credit. It is probably one of the most important forms of credit. Remember, all of this kind of stuff, if you've never heard about it before, these are just examples, little tidbits of all of the stuff that we cover in the amazing programs on Building Your Wealth link down below, including the Elite Hustlers course for entrepreneurs, starting a side hustle, LLCs, insurance, liability, stocks and psychology of money, real estate, how to actually go from zero to millionaire. It's not that hard in real estate. It's actually pretty easy. Just follow the steps in the Zero to Millionaire course. Anyway, link down below. We've got a coupon code expiring at the end of the day tomorrow. But with that aside, blocks are business lines of credit. They're very important. They're very important because contractors or even manufacturers, they use lines of credit to buy inventory. While they use the line of credit, they can manufacture their product or complete a job for their customer. And then after that, what can they then do? Then they can bill their customer, pay off their line of credit after paying all their bills. It's very typical to use a business line of credit to do that. By potentially crimping lending standards and crimping business lines of credit, especially from smaller banks, you could really be crimping the economy substantially more than anybody is projecting right now. And I have to give a credit to the Bears for this. The Bears are right to say that all of these different types of loans don't need to see a lot of tightening to really crimp the economy. I just showed you one of them, business lines of credit. Business lines of credit getting a 50% haircut could shut businesses down. You could see mass bankruptcies. Now, there's no guarantee that these things are going to happen, but let's just say I moved some money from some of my credit lines yesterday to basically have that money drawn down, and I'm just leaving it in cash to give me more flexibility in the event that banks start crimping down on credit lines. The same goes for, now these can often be deemed more discretionary, but boat loans and plane loans, these are massive segments of the economy that of more of the wealth economy, but they lead to a lot of additional spending. The maintenance, the piloting, the captaining, the fuel, the warranties, the amount of money, the amount of GDP that's created when somebody buys a plane or a boat is insane. Just because there's so many ancillary costs to the individual product. Somewhat different than a mortgage loan. People might move in and get some new appliances or whatever, but they're not bleeding money like they are with a boat or a plane usually. Mortgage loans getting tightened, personal lines of credit or personal loans, home equity lines of credit, rental property lines of credit, these already basically went away in the pandemic. Margin, of course, margin lines get credit or get squeezed. Car loans, credit loans, those are more basic. I mean, y'all can imagine that. That's a little bit more basic. So, Morgan Stanley talks a lot about this credit crunch being evidenced by this steepening of the yield curve, this 60 basis point steepening in the yield curve, which we've only actually seen a few times before in history. And what they say here is they give us this beautiful chart and they say, look, growth risks become increasingly apparent when the yield curve re-steepens from a trough, much like now. Look at the last times we've had a re-steepening of the yield curve. Let's go back to 1979. Oh, recession right after that. Bummer. Let's go to the early 80s. Oh, recession right after that. Bummer. Let's go to 87. Oh, recession right after that. Recession being the big red bars. What a bummer. Now look at where we actually had some soft landings I'll show in just a moment as well. But here you go, dot-com bubble. Here you go, 06, 07. Here you go, 2019. Although that walked into the pandemic, so I'm going to put an X on that one because I think that was really convenient. That could have been a soft landing and not a recession had it not been for the pandemic. But let's actually take purple. Let's take the purple line color here, and let's show steepenings on soft landings. Look at that. The famous mid-90s soft landing. Look at that. The re-steepening over here twice in the mid-80s without a recession. Look at this. The famous 2013 re-steepening. So you can have re-steepenings and no recession. It has happened. So it's kind of tough to say. Like Darren makes a fair comment. Darren writes here, but this time is different, LOL. He's making the reference to, hey, like all these greens are clearly telling us that when we re-steepen here, we're going to have a deep recession, right? But it's not that easy to say this time is different because which time is different? The time we had the soft landings, these 3 moments of re-steepening over here, or the time we had recessions, these 5 times? I don't know. So I think the re-steepening is a little bit of a mixed tell. I think the bear argument is much more reasonable in a credit crunch, that is the lower availability of credit via the sources that I talked about, and then also the potential for a lower velocity of money leading to lower spending. And I'll show you where I think that lower spending will be with some specific stocks. So anyway, they talk about the velocity of money in banking potentially falling sharply and likely offsetting any kind of QE money printing or increasing in the money supply. So even though we're seeing that QE up and Bitcoin sort of cheering that idea, if the velocity of money goes down, maybe you actually won't see the benefits of that as directly. So instead, what do we want to pay attention to? Well, maybe we pay attention to earnings and the fact that even though earnings have come down, they, according to Morgan Stanley, have remained sticky, and in some cases have actually risen here recently. And so then they also discuss how the earnings risk premium is way too low. In other words, why would you put your money into stocks right now when you could make so much money risk-free via treasuries? The spread is too low. Now, to counter this, one of the reasons the spread is so low is because nobody expects those treasury yields to remain as high as long, and the opportunity cost in stocks is actually widening. That if treasury yields plummet and the stock market, goes up 50%, well, fantastic. Now we can explain why the earnings risk premium is so low. So this is where I want to talk about some specific stocks. And the first sector that I like paying attention to is, here's a Seeking Alpha piece. You can actually sign up for Seeking Alpha by going to betkevin.com/seekingalpha. I like them. Sometimes there's good perspective. You just have to understand who's writing it because sometimes you get biased authors over here, but they do have some really good perspective. So the first sector, because I want to go through the S&P 500 over here. We're going to go through the S&P 500 and I'll explain some of my thoughts on some of these different stocks. But when it comes to actual chip expectations, they make this cautionary note here to say that you should temper your expectations for chips. And I agree. I don't think we want to assume that chips are going to explode. Now, Nvidia stock has exploded, and so have some other stocks, even like Taiwan Semiconductors from their lows. But that's in part due to really highly negative expectations that we had for the PC market, dropping over 30% in sales. But they make this argument here that you have mixed conditions in the near term for chips. They think that data center orders appear to have weakened further in the past few weeks, whereas PCs, TVs, and smartphones have potentially hit a bottom. Now, this is actually reiterated by Amazon potentially indicating slower revenue in their data center space, which when we went through the Amazon earnings report in our course member live stream, let me see if I have it handy here, we saw exactly that kind of softening. I'm not sure if, oh yeah, here it is. Look at that. So this is the kind of stuff we generally do in our course member live stream. We pick a company, we do some fundamental analysis, and we try to pick up on trends. For example, we recently went through the Honest company and how horribly honest that earnings call and the actual earnings report was. You could see the full archive, of course. Remember live streams and the fundamental analysis we do in the courses. Which remember, you get lifetime access. You buy one of any of the courses, you get lifetime access to all of them. Well, to the live streams. But anyway, with the exception of the Elite Hustlers, that has its own separate live stream. But that's a Sunday live stream. But what we wrote here is that AWS growth has slowed to under 20% growth, whereas it used to be closer to 30-40% growth. And on top of that, they're seeing margin compression in the AWS space, which is starting to indicate a lack of pricing power. It's one of the reasons I personally have stayed away from Amazon, because I don't think, they certainly don't have pricing power on merchandise. I think they lose hand over fist on merchandise. I don't want to be exposed to the creative sector of Amazon, which would be the TV segment. I think that's a money loser, the production studio. So I think the production studio is a money loser. I think the merchandise is a money loser. And the only section that prints money is the server section, and I'm seeing margin compression and lower sales. So for me, I'm just not excited about Amazon. And that's my reason why. Now, don't get me wrong, I think it's a fantastic company. I love Amazon as a consumer. But do I want to invest in them? No. But anyway, let's go back to this Morgan Stanley piece here. Actually, we got to finish the chips piece. So what else did the chips piece say here? So chips piece, they actually raised their price target on Intel, which I think is very interesting because I actually think Intel could be one of the very few actual value plays out there right now. Now, anytime you say value, you have to ask yourself, are you looking at a value trap? So that's a risk. But I actually think Intel is taking a very smart approach by manufacturing for both the RISC architecture, ARM, RISC ARM, right? And the x86 architecture, which is their proprietary version. In English, I think they're taking a very smart approach manufacturing chips for everyone in the industry and not being so heavily reliant on just their own proprietary chips like, Intel Pentium inside. Who remembers those days where all the TV had boom, boom, boom. I can't do the sound, but anyway, I remember Intel Pentium inside. And then it went to Intel Centrino for laptops. But then again, I'm also I'm of the generation, this makes me sound so old. I'm also of the gen where, and then we got to talk about the S&P 500 here, but quick tangent story. I'm of the generation where I played so much freaking RuneScape that when I played so much RuneScape, I remember, well, first of all, I remember being mind blown that I could actually play a video game with my friends online. That was like 6th grade, like, how is this possible? We used to have the LAN party. But then I also remember thinking, wait, maybe this means one day I could actually take a laptop, because yes, laptops existed, but maybe one day I could take a laptop to dinner. That was my thinking when I was a child. I was at a pizza shop with my dad, Antonio's. So we're at Antonio's, and I'm like, Dad, maybe one day in the future, I could sit here with a laptop and play RuneScape while I'm sitting here. It's just like, it's so weird thinking back to that, because that's a long ass time ago now. That's like 17, 18 years ago. And I'm just thinking to myself, like, man, it's so weird how far it's come. It's going to be so weird thinking about how, like, what my kids' memories are now going forward another 20 years. Anyway, let's get to these S&P companies. So I think that's really cool. Was there anything else in this one here? Early signs of recovery in PC, great. The graphics chip maker, Nvidia, strong buy rating on Nvidia because of AI technologies. I have a big position in Nvidia too. I actually agree. There's a potential that Nvidia is a little bubbly right now, kind of like Metaverse made certain companies bubbly, like Metaverse propped up Matterport to extreme levels. There's a risk that some of that's happening a little bit at Nvidia as well. But these are what I think about the S&P 500 companies. And this is where I actually think Morgan Stanley and the Morgan Stanley Bears are right to say that there could be an earnings recession for S&P 500 companies, specifically the pink ones, because there are so many pink ones here. So I highlighted green ones as what I think are companies that have big PP. So I think Apple has pricing power. I think Nvidia has pricing power. I think Tesla has pricing power. I do not think Google has as much pricing power. And I also don't believe that Microsoft has as much pricing power. So I think these guys don't have as much pricing power as Apple, Nvidia, or Tesla. That's just my take. And then companies that I almost think certainly do not have pricing power are Meta. I hate to say it, it's just what I think. That doesn't mean it wasn't a good buy when it was super cheap at $80. That's fine. I personally just think they burn way too much of their free cash flow and their profits on the metaverse, which I'm actually not the biggest believer in. So short-term trade, fantastic on Meta. Long-term, not for me. J&J, any kind of staples, I disagree with staples and financials, although I am tempted by the idea that there could be a swing trade on a company like JP Morgan when the banking crisis is over. Morgan Stanley has a belief that right now they're overweight healthcare, which I know nothing about, so I'm going to stay out of commentary on healthcare. I don't know anything here. Staples, I disagree with. I think you're negative on staples. I think you're negative on utilities and energy and materials because they've been blown up as recessionary defenses. Certainly negative on real estate. Maybe there's a trade on financials, but I don't like holding those into a recession. And I actually think you're more likely to have good upside, hashtag not guaranteed, in specifically the PP versions of discretionary tech and comm services. However, not the non-PP ones. The non-PP ones I want to stay away from, the non-pricing power ones. And I have an example of some of those, Nike being one of them. Nike and the clothing ones, I really think as we go through this next 6-month period, JP Morgan thinks that by Q3, the lower income individuals, the lower income set of people will have run out of excess savings. And that's going to hit your Lulus, your Nikes, your Under Armour, basically your discretionaries. It'll probably also hit your lower income homeowners, and especially as the real estate market slows down, which would be a hit to Home Depot. Financials, I stay away from. Visa, MasterCard, JP Morgan, I stay away from them. Again, I do think there's a potential play at JPM. If I was going to pick one of the card companies, it would probably be Amex because they appeal more towards the wealthier cohort. I think the staples were your run-to in the recessionary fear environment. So your Pepsi, Cokes, I think, and like the McDonald's, ridiculous in my opinion. I'll give you an example of why McDonald's. Let me pull my last McDonald's look over here. MCD, McDonald's. So, do I have it handy? Maybe I don't have it handy. But anyway, we went through McDonald's in the McDonald's earnings call just a few weeks ago, the McDonald's revenue reports. And what you're finding is that, bottom line, the wage increases that they've been forced to take are really starting to impact their margins substantially. At the same time as consumers are, like the average value of a meal purchased at McDonald's is going down. So you're seeing revenue pressure, negative revenues year over year, revenue pressure, and higher cost pressures. To me, it's the opposite of pricing power. So it's just my thesis. Could be wrong, but my thesis. So continuing on here, I will say I have a potential attraction to SaaS companies with high cash flow. Salesforce, Bill.com, otherwise. I think there's a potential there. However, I'm worried that those are the first ones that in the short term institutions are dumping going into a recession, especially as we have a lower new employee base at companies and potentially more cost cutting at companies. So I'm a little bit torn. Out of Salesforce and Adobe, I have exposure to Adobe, but it's low. So we'll pay attention to this. AMD is another good one. I guess that should, in theory, be green. Raytheon, look, the defense companies, they're so backlogged. Certainly, you could argue they have pricing power, but you're not in a position where they can do much about it. They can't expand manufacturing capacity fast enough. Aerospace is another space that has substantial pricing power. Unlike Lowe's, for example, which I don't think going into a recessionary environment you have a lot of at all. And Broadcom's exposure to memory and Qualcomm's exposure to 5G makes me a little less excited about them from a chip POV. So those are some of my theses on individual holdings. Now, regarding the bear thesis, yes, Morgan Stanley has points about this earnings recession. They're not wrong. Bottom line is that we think this is exactly how a bear market plays out. An unforeseen catalyst that is obvious in hindsight, forcing market participants to acknowledge what has been right in front of them this entire time. In this case, it's the fact that earnings growth expectations are too high given the headwinds companies are facing. Now, in fairness, this is interesting too. Somebody writes, McDonald's has raised menu prices extremely. Food still sucks. Yeah, but look at margins. McDonald's did introduce the chicken Big Mac though. Did they really? When they got, is it fried chicken though? When they got rid of their actual grilled chicken products, I got very upset at McDonald's because then I had nothing left to eat over there. I don't want the fried fish, although the filet fish is pretty good. Back when I used to go to debate camp, there was a guy who would always order filet-o-fish, and his name was Mitch. So everybody always called him Filet-o-Mitch, or something like that. I can't remember. I don't know why I'm talking about that. Let me, maybe because I'm trying to pull up I want to see the margins. Let me see here if I can grab their last report. So where are we here on McDonald's? So on McDonald's, consolidated revenues were flat. We have consolidated revenues decreased 1% for the fourth quarter. For the full year, we were flat. So we were negative for the fourth quarter. Here you go. Taking a quick glance at this. So you're negative in revenues for, thanks to currency adjustments as well. Negative in revenues for the quarter, flat for the year. And then we are at, let's see here. I want to see margins if we can. Let's see. This is the last quarter here. So if we look at margins, let's take a quick look here. Operating income. Remember, McDonald's makes most of their money from franchising. And you could see that here. That's what's so beautiful about, this is for the quarter ended in Q4. Their margins are so high on franchising. If you want to make money in restaurants, franchise. Look at Red Robin or Cheesecake. They lose money hand over fist on actually operating a restaurant. And McDonald's has pretty low margins as well when you look at the actual company-owned stores. The margins are okay, but they're nowhere near what their margins are for franchising. Franchising is where they make the money off the brand value, basically. So that's something to pay attention to if you're looking at these companies. They were still able to grow EPS, though, year over year, 16%, which is fantastic. But you do have that sales by company, year over year, comparing the last quarter, down 13%. Other revenues down 7%. They did make a little bit more money raising prices on their franchises. But even though they're raising prices, they're seeing those revenues come down. And I think that's a sign that people are a little resilient to their to these price hikes. And let's see what margins are actually doing. I have a calculator handy here. Let's look at margins. If we just do a quick look here, usually we do this kind of stuff in our course member lives. We're looking at 15.2% on company margins versus, look at that margin compression, 17.2%. So in other words, you were at 15.2 right here versus 17.2 in 2021. What I did is I divided their expenses right here by their revenues to get a margin number. You have to subtract by 100. Then you get the margin number here. Their margin was 17.2%. That fell 200 basis points. So you're seeing negative sales, margin compression. I think that trend continues. At the same time as year over year, the stock is actually held up. And I've been saying probably for about a month now, I think this thing is going to walk into some pain. It's been flat the last month. But the fact that it's done so well since January of 2022, if I go to just the week chart, you can see it very easily here. This is the week chart for McDonald's. You can see it's actually held up pretty dang nicely. I wouldn't be surprised if it comes down to revisit the 200-day moving average, and that ends up being what you kind of see in an earnings recession. So I think this segment here is really a tool for you to see, hey, look, if you're looking for a potential earnings recession, the place to probably look is in companies that have done very well as staples and flight to safety style stocks over the last year. And I think that's where we could both be right. Like, can you believe I'm about to say this? Mike Wilson, the big perma bear at Morgan Stanley, and I could both be right. That is, pricing power stocks do well through a shallow recession or no recession. However, the S&P 500 performs poorly as staples and the companies I showed mostly that lack pricing power end up underperforming as their earnings estimates are too high. Now, he does say mega cap will not be immune to these growth concerns. And I agree for Facebook, Microsoft, and Google, but not for mine. Has nothing to do with my bias at all. Anyway, obviously, I'm placing my bet. Now, one thing that I agree with him on clearly is being careful of small caps. Small caps have a lot of debt and very thin profit margins. I completely agree with him on that. And that is why almost every small cap that I've been analyzing with course members has not been very attractive. So, be careful. Stay safe out there. I love y'all. Thank you for being here. Thanks for being subscribers. Get life insurance in as little as 5 minutes. Go to metkevin.com/life. Seriously, literally, go to metkevin.com/life on your phone, and you can Apple or Android pay for it. And then you can tell your family, Mom, Dad, I got life insurance. They're like, oh, how long did that take? 5 minutes. Then give them your referral link. Yes, paid partnerships. Webull, 12 free stocks with Webull. And then, of course, coupon code expiring tomorrow for those programs on building your wealth. So there you have all the perspective. Either way, I appreciate you being a subscriber. Share the videos if you find them helpful, and we'll see you in the next one. Go into the course member live stream now.